Morning, good afternoon, good evening. This is Samuel D speaking. Actually, I've been trading for 4 to 5 years, and I have a lot of friends, family members, couple mates I know who keep on asking me to show them or probably teach them Forex or how I trade my Forex to make money. And since I don't want it to be kind of repeating myself over and over, teaching individual like everyone separately, I decided to record this video whereby it will be uploaded on my YouTube channel. Then whenever everyone asks me, I can directly send the person there to watch it. So I'll start from the basics today. It will be 5 episodes or 5 sessions, which will cover all the basics, starting from the definition of Forex, pips, margin, leverage, technical analysis, fundamentals, how to read charts, how to use indicators, and all that. So I wish you stay with me till the end. So if you say Forex, how do you understand Forex? Forex can be broken down by its name as the FOR meaning foreign, and the EX meaning exchange. That's where we got the name foreign exchange. So as a whole, we have something called the financial market. It's likely you hear someone being like, I trade the financial market. So the financial market is very big, very broad. It consists of Forex trading, crypto, stocks, shares, bonds, metals, such as gold and the rest, and a whole lot. So Forex is just one aspect under the financial markets or the financial branch. So as I said earlier, Forex is just exchanging one foreign currency for the another. And Forex is the biggest financial market you will ever find on the globe. It's usually traded around 4 trillion to 5 trillion daily. As you can see here, estimated value transacted daily is 4 to 5 million. So before Forex can work, it's just the exchange rate between one currency to the other. And the main currencies we mostly use in Forex are the euro, USD, the euro, the US dollar, Australian dollar, Canadian dollar, Japanese yen, and the Swiss CFA francs, mostly the currencies pair we use. Actually, I will skip this slide and probably come back to it later. So in Forex, it's either you are buying a currency pair or you are selling a currency pair. So to buy a currency pair, first, you have to pair two currencies. And the first currency, which you will see in your currency pair, is called base currency. Then the second one, which was being attached to the base currency, is called a quote currency. So if you say like this, basically we are using the base currency to buy the quote currency. And if it's the other way around, if you are selling, meaning we are selling the US dollar, which is the quote currency, to get the base currency. And in the Forex market, since it's a very huge market which trade around 4 to 5 trillion US dollars every single day, you depositing $100, $200, $500, $1,000, $10,000 is relatively very small in the Forex market. So we have something we call leverage. As the definition of leverage insists, maybe I'll search for the definition, then I'll come back here and share it with you. So just a minute for my link to open, then we'll take it from there. Leverage. So leverage, as we can see the second definition, a ratio of a company's loan capital, debt, to the value of its original equity. So leverage, it helps us use the maximum advantage, as this one suggests, use something to its maximum advantage. So leverage is just something to help us heighten or increase the capital we deposit to trade Forex. So for instance, if we deposit a $10,000 account, if you are trading with a $10,000 account, since it's relatively very small to the 4 trillion traded daily in the Forex markets, using a leverage of 1 to 200 will give us, just have to make the calculation, sorry. So 200, so it will be 200 times the 10,000 we are trading with. And that will give us 2 zeros, 1, 2, 1, 2, 3, 1, 2, 3, 2, 3, then times 2. So to give us 2 million to trade with. So technically, we will be trading with 10,000. You will be having 10,000 in our account balance, but you have the chance to trade with a volume of 2 million US dollars. So just like the same thing implies, if we have a $10 account and we are using a 1:200 leverage, the $10 will have a trading option to trade with $2,000 worth of either selling or buying. It won't be the $10 as we saw earlier. We're supposed to create a demo account so that we'll be using later, but I'll skip it so that when we get there, I'll give you guys a link. You subscribe and you register with that link, then we'll take it from there. As I said earlier, it's either we are buying, and once we are buying, we are using the first currency pair, which is the quote. And so which is the base currency for a quote currency. And if we are selling, it's just the vice versa. So I've already given you the Forex pairs. So some currency pairs are the Euro Pound, Euro JPY, the GBP JPY, which is the Great British Pound, Japanese Yen. We have commodity pairs and all that. So currency pair is just using one currency to get the other. So right now we will talk about something called pips and pip value, fractional pip. If we say a pip, for instance, a pip is the difference from where an entry or a position is being opened till where we close, or it's just the difference between a price or two prices. Let's say $1, 1 euro is equal to $1, $1.20014. So if the price goes up from 1.20014 to 1.2010, meaning removing the fractional pip, deducting the 1.2010 from the 1.2001 will give us 9. So meaning we have traded 9 pips, or the difference between the two prices will give us the pip. The fractional pip, it starts from 0 to 9. So once it gets to 9, it will be added up to this one. So in case we get 1.2001, 4, it can go to 15, upwards to 19. So if it turns 0, if it goes up, then this technically is 14. If you are taking it in fractional pips term. So once it gets to 19, it changes to 20, whereby this one will be a full pip and the fractional pip will be 0. So pips basically means the difference between two prices. That's it for pips. Then we have something called lots. A lot of people get confused understanding the lot size, the normal standard lot, the median lot, and the micro lots. A standard lot is worth 100,000 units of the normal value of the base currency. A median lot is worth 10,000, and a micro lot is worth 100,000. So lot basically means the lot of measurement or the units you are selling or buying a currency at. So let's say one standard lot, which is 1. So let's say I'm buying one standard lot of Euro USD, meaning every pip, just like it has been explained here, the equivalent of $10 movement. So meaning if you buy a standard lot, every pip, and as I said earlier, the pip will be, so let's say this moved from it moved from 1.20014 to 1.20024, meaning we have moved 1 pip. So that pip value, if you trade a standard lot, the pip value is equal to $10. And as we trade a mini lot, the pip is equal to $1, and as it